Hello and welcome to Chapter 9 of Auditing and Assurance Services. In this chapter, we are going to discuss the production cycle and how to audit inventory. And here we see a quote from Henry Ford. There is one rule for industrialists, and that is make the best quality of goods possible at the lowest cost possible, paying the highest wages possible. So these are our Chapter 9 learning objectives, where we are going to learn how to describe the production cycle, including those typical source documents that we as external auditors will be investigating. We're going to identify the significant accounts and the relevant management assertions that relate to the audit of inventory. As always, we are going to consider material misstatement in the audit of inventory and identify those important internal control activities that are present in a properly designed internal control system to hopefully mitigate that risk of material misstatement for each of those management assertions in the inventory management process. We're going to give examples for those tests of controls to test that they are operating effectively and are able to manage inventory. Then we're also going to give examples of those substantive procedures in the audits of inventory and those related assertions that those substantive procedures are testing. And lastly, we are going to actually perform some audit procedures on inventory and then hopefully learn how to evaluate the results of those tests. So let's start with our inventory management and the relationship between those business cycles. So here we see in this visualization that the production cycle links the acquisition cycle, which is in which the goods and services are purchased, and it links it to the revenue cycle, which is where the inventory is sold. And these cycles coincide with the payroll cycle as well, and that accounts for all of the additions and reductions of the inventory items. So we're looking at the production cycle, which is mostly concerned with how we account for inventory as it moves through the production stages, where we're looking at raw materials, work in process, and finished goods, the three inventory items in a manufacturing process. So when we're thinking of inventory management, we have several typical activities. As you can see, we do some sales forecast. We also have to do some production planning, where we look at the production plan and the bill of materials. We also have to look at production and inventory controls, such as the purchase order, the materials requisition, and the materials transfer ticket. Then we have to think of our cost accounting, as we are accounting for the standard costs and those allocations of manufacturing overhead. So now we are in the risk assessment process. And so when you think of the significant accounts, we're looking at inventory and expenses, and then the relevant assertions such as existence, completeness, cutoff, valuation and allowances, evaluation and allocation, rights, presentations, and disclosure as they relate to inventory, and completeness and accuracy as they relate to expenses. So when we're considering the risk of material misstatement, we're really just considering what could go wrong in the production cycle. So as auditors, we need to be concerned with several primary concerns. First, the items included in inventory were in inventory on the balance sheet date. So that would help us to understand the management assertions of existence and cutoff. Secondly, all inventory items have been included, which would test completeness. Third, we would see that inventory has been properly accounted for and valued using those GAAP accounting methods, which would substantiate valuation, that the inventory items included in inventory were the property of the client, which gives us rights. Proper presentation and disclosures have been provided for as relates to inventory, testing the presentation and disclosure management assertion. Cost of goods sold includes all of the costs of the inventory item sold, which would test completeness, and the amount of cost of goods sold has been properly accounted for using those acceptable GAAP accounting methods to test accuracy. So here we see the significant accounts such as inventory and cost of goods sold, and each of the management assertions and what could go wrong. So for example, when we look at existence, we have items that are included in the inventory records are not actual items in inventory. When we're looking at completeness, that means that some items may not be in inventory. As it relates to the management assertions of cutoff, we're looking at inventory transactions that occurred near year end, but were not recorded in the correct period. As for valuation, we're looking at the inventory cost flow assumptions, such as FIFO or LIFO, that they have been applied incorrectly, or the proper costs for direct materials, direct labor, and manufacturing overhead are not allocated to the actual inventory that was produced. When it comes to presentations and disclosures, we're looking at inventory that might be pledged as collateral that has not been disclosed, or cost flow assumptions that are not disclosed because they're misclassified among the raw materials, work in process, or finished goods inventory balance sheet accounts. When we're looking at cost of goods sold, we're thinking of the labor or materials that may be omitted, which would test the relevant assertion of completeness. And for accuracy, we're making sure that the costs of direct material, direct labor, and manufacturing overhead have been properly calculated. So when we're considering internal control activities and design evaluations, we are looking at entity level controls here, and those considerations are that production runs are authorized, raw materials should be counted and inspected. As production is undertaken, the material and labor quantities are summarized. All inventory items should be accounted for, whether they're used in production or scrap or returned to inventory as well. Then we're looking at production labor reports that should be approved and reconciled with the payroll records, and finished goods inventory production records should be reviewed by the production supervisor and then forwarded by that individual to the accounting department. And we should count and inspect the items and compare those quantities to our perpetual inventory records. So when we're looking at the cost accounting department reviews, we're looking at the quantity of the raw materials and checking that to the materials requisition. We're looking at the direct labor in the timesheets and making sure that they coincide with the labor distribution report. We're also looking for the application of overhead costs and how that is allocated in the overhead tickets and an overall cost summary. So when you're looking at the internal control activities as they relate to inventory, we still have the same management assertions, and now we've already discussed what can go wrong. So now we're looking at the internal control activity that we can put in place to hopefully help us with those relevant assertions. So for example, any transfer of inventory must be authorized, right? So if it's periodic physical inventory counts with the reconciliations of records are performed, that would help us with the management assertion of existence. And then, for example, with cutoff, the receiving reports, if they're pre-numbered and used in sequenced and they're reconciled, that will help us with the cutoff. And additionally, for the rights management assertion, we would have a separate account number to track those inventory that is on consignment. And then when we're looking at the assertion of presentation and disclosure, we would want to make sure that management reviews those financial statement disclosures, and we might want to possibly have a disclosure checklist that's completed before we issue those financials. Then for costs of goods sold, our expense as it relates to the management assertion of completeness, we would check the cost sheets are reviewed for all the projects and the production runs. That way we're including all of the relevant costs. And we would also look at the bill of materials and direct labor requirements, that they're approved, and make sure that the correct cost allocation calculations are used. As we relate to inventory as our significant account, and if we're looking at existence, we would want to inspect the documentation of that authorization for those inventory transfers, or inspect the documentation of periodic inventory counts and that reconciliation. When we're looking at the cutoff assertion, we might want to look at those receiving reports, make sure that they are sequentially numbered, and also reconcile them. As we are looking at, for example, presentation and disclosures, we would want to inspect those disclosure checklists and look at the documentation to make sure that it was reviewed by management as well. And when we're looking at cost of goods sold or COGS, and if we're looking at the completeness assertion, we would examine the documentation of the cost sheets. We would also inspect the documentation of authorization of the bill of materials and direct labor requirements. We want to trace that bill of materials and those labor reports to the job cost sheets and make sure that all the costs are included. Then when we look at additional risks and additional controls as they relate to the production cycle, we would look at the occurrence and the completeness, and then look at the internal control activities that might be in place, but more importantly, conduct those tests of internal controls, which are attribute tests. So if you're looking at occurrence of production and those related events that have been recorded but haven't really occurred, we would want to observe separation of cost accounting functions from those of the production, payroll, and inventory control functions, and also look for reconciliations. When we are thinking of the completeness, that some production documents have actually not been recorded, we would want to inspect evidence of possibly reviewing the numerical sequence, maybe looking at the inventory counts and comparing those to the perpetual records, investigating the reconciliation of the production costs to the work in process inventory, tracing those receiving reports and to the inventory, and tracing materials used to the production cost reports to make sure everything ticks and ties. And then when we're looking at the accuracy here, where the production information and the costs possibly haven't been recorded properly or calculated properly, we would want to do comparisons. We would also want to investigate the material and labor usage reports, and then look at evidence that the client actually reconciled the inventory counts to the perpetual records. When we are looking at cutoff, so this is that the production events have not really been recorded in the correct accounting period, then what we would do as external auditors is to vouch the dates of the inventory records to those receiving reports and inspect the production data and make sure that that agrees with our finished goods inventory, and then also inspect the production reports and make sure they agree with the journal entries that were posted. Then when we're looking at classification, which basically tells us that the production materials have not been recorded in the correct account, we'd want to look for some supervisor allocations, test that allocations, and make sure that the supervisor's signature was there as some sort of attribute to show that they reviewed it. So when we're looking to test the production cost controls, we're going to look for the completeness direction. So here you see the purchase orders, and we would take a sample and make sure that they were authorized, and then we would match that sample to the bill of materials and then make sure that the issue slips, those materials used in the production reports, we test it back, and also to the labor reports as well. Then when we're looking at the occurrence management assertion, we might have the issue slips for the materials that were used, then make sure that those materials used are actually in the production cost reports, look at the overhead analysis and labor reports and make sure that everything was recorded properly. So we would vouch the labor and vouch the overhead and compare those. And now when we're looking at our substantive procedures in order to audit inventory, obviously our significant account is inventory, and then each of the management assertions that we discussed. So we already know what could go wrong, the internal control activity, and the test of controls. So now what we're focusing on is our possible substantive analytical procedures and our test of details. So for the existence management assertions of inventory, we would compare inventory turnover ratios to possibly budgets and year over year. We can also compare the gross profit percentage to budget in previous years. And then in terms of substantive test of details, we would have to observe the client's physical inventory count that is required by the PCAOB auditing standards. Then we would confirm any inventory that was held on consignment and vouch the items that are listed in inventory to those inventory count tags that were conducted during the physical inventory observation. When we're looking at completeness, then we would look to observe not only the client's physical inventory count, but then ensure that all items were counted and then trace those counts to the inventory listing. When we are looking at the management assertion of cutoff, we're going to look at the sales and purchase and perform cutoff tests by possibly looking at the last few invoices, 5 to 10, and the first few, and making sure they were recorded in the correct period. Then when we're looking at valuation as the relevant management assertion, in order to perform analytical procedures, we would possibly compare the average unit costs of inventory with prior periods and the purchase records. And when we are looking at the possible substantive test of details, we're going to actually test that mathematical accuracy of the application for the cost flow assumptions. And then additionally, we can vouch the inventory cost to the standard costs and then recalculate those standard costs as well. When we are looking at the rights management assertion, here we would inquire of management whether any inventory was held on consignment for anyone else. And then when we look at presentation and disclosure, when we're looking at the possible substantive test of details, we're going to inquire whether inventory has been pledged as collateral or security for some form. We're also going to perform the bank and loan confirmations and inspect those lending agreements or any other contracts that might have used inventory as collateral. Additionally, we are going to review the inventory calculations to make sure that there is proper classification for the raw materials, the work in process, and the finished goods, which are the three inventory accounts for a manufacturing entity. And then we might also vouch the classification of the inventory records to those subsidiary records as well. And now when we're looking at cost of goods sold or COGS, if we're looking at the completeness assertion, then when we're looking at our analytical procedures, we might compare the unit costs of production with prior periods or with budget, and then compare the actual production units to what was budgeted. And then when it comes to substantive test of details, we will trace the labor costs from the payroll reports to the production cost sheets. And then if we're looking at the cost of goods sold as it relates to accuracy, we will recalculate those standard costs. And now when we talk about the physical inventory, which is the client that they're going to do the count, we would have certain instructions for them, such as like what are the names of the team members, what are the dates, what are the instructions to the team members, are making sure that there isn't any obsolete or damaged items. We're going to look at the tag control, making sure that everything was counted. We're going to ensure that the client has shut down production. We are also going to control the inventory movement, such as shipping and receiving. Nothing can come in or go out, so it stays, so we can get an accurate physical count. We're going to look at the instructions for the supervisory approval and then make any changes or corrections as they are necessary. And then when it comes, we're going to observe the inventory count, and we're going to test the prices and the compilation of those counts, and then perform our own analytical procedures, making sure, do we have excessive inventory? What are those slow-moving inventory items, and will we have to write them off? And then we are required as external auditors to make or observe some physical count of the inventory and then apply the appropriate tests of those transactions. So usually we would make some test counts at the time and then either roll forward or roll back those test counts to ensure that that count was accurate. We're also going to review the client instructions, hopefully stop the flow of goods, And when we make these test counts, we're going to do them from the inventory listing or from the warehouse floor, and then record everything in our work papers. So from sheet, which is the warehouse list of inventory listing, to floor, or floor to sheet. And then we want to make sure that we listen to the instructions that were provided to the count team, and then understand if the client is using some type of control tags or count sheets. And we don't want any hollow squares or empty boxes. So we want to make sure that we ensure that we want to tour shipping and receiving areas, look for any obsolete or slow moving inventory, confirm if any inventory is on consignment, and if we need to, we might use specialists. And then we also have to look at inventory in transit as an external auditor. So most companies, thankfully, use some sort of technology when they are doing inventory counts, such as scanners or the RFID. And we also have now drone technology, and that can be used, for example, if you want to do physical observations of farm animals like cattle, or do consistent locations of warehouses as well. So new technology is helping us be better auditors. And then when we're looking at the valuation or the price tests, we're going to look at the vendor invoices and get our inventory valuation, which is FIFO or LIFO or weighted average or specific identification. And then remember to make sure that we apply the lower of cost or market to our inventory valuation. Check all of the extensions and footings and make sure that we agree the valuation to our general ledger. And then when we're looking at the presentation and disclosure assertions, we're going to make sure we look for occurrence, rights and obligations, completeness, classification and understanding, and accuracy and valuation. So when we consider the application of the audit risk model, so basically what we're trying to do here is apply the audit risk model to test the assertion of existence in the production cycle. So as you can see below, we have the extent of the substantive inventory procedures that we would conduct for the existence assertions, and that can be accomplished based on the detection risk. So if we have low detection risk, then we would observe the physical inventory count at year end. We're going to take a substantial number of test counts, and we're going to use large samples for vouching those inventory purchases. We're also going to perform analytical procedures during planning and at the audit completion. Now, if we have a high detection risk, then we're going to rely heavily on those analytical procedures. We're going to observe the cycle counts in inventory, but then rely on the roll forward procedure where we don't have to test as much. So some fraud red flags as they relate to inventory. If we see uncontrolled access to inventory, that means inventory can possibly be stolen. If we have several high dollar items that with market value, if we have unexpected counts during the inventory, that might be of concern. If there are large differences between the counts and the inventory records, that could also be considered a red flag. If the inventory shows signs of damage or obsolescence or too much quantities, that could be a red flag. If there are some type of unusual internal plant transfers during physical inventory at the end of the year, that could be of concern as well. And if the client is reluctant to move merchandise to allow for the inspection, or if the merchandises are located behind something and you don't get access to it as an external auditor, that could also be considered a red flag. So one of the key tools is IDEA, and that is a data mining software that is typically used in auditing. And now we also use Alteryx as well. And so those are both data mining softwares. And what we can do in terms of inventory testing, we can actually apply this equation, right? Beginning balance plus purchases minus inventory usage equals our ending balance. And we can actually practice with what would happen. And if you look in your textbook, these exercises here will walk you through step by step on how to use IDEA, and I highly recommend it. Then we have what the PCAOB, the Public Company Accounting Oversight Board, tells us in terms of inspection deficiencies. So if the firm failed to perform those sufficient procedures as they relate to inventory, a significant portion of that issuer's inventory was located in one warehouse, and the firm selected for testing a control over the existence of this inventory. So the control required that at least 80% of the inventory storage locations at this warehouse be counted at least once a year. The firm failed to evaluate whether this control was designed to appropriately address the risk as it relates to the existence of inventory. So specifically what happened here is that the audit firm did not evaluate whether this control, which required that only 80% of the inventory storage locations be counted, could effectively prevent or detect a material misstatement of the inventory that was located in this particular warehouse. So then we have substantive tests of inventory. So the PCAOB requires external auditors to perform detailed inspections of the audit process employed by each firm auditing publicly traded corporations. So a formal inspection report would be issued by the PCAOB for each firm that they inspected. And in a recent inspection report, the PCAOB highlighted the importance of substantive testing of the client's inventory. So the first listed deficiency was identical in multiple inspection reports, indicating the focus of the sample size by the PCAOB. So the sample size the firm used in certain of its substantive procedures to test certain items of inventory were too small to provide that sufficient and appropriate audit evidence, because those procedures were designed based on the level of control reliance that was not supported due to the deficiency in the firm's control and testing. So in the substantive testing, the firm identified differences in those unit costs of inventory between the system, but really didn't perform anything to see what caused that difference. And this was of KPMG, as you can see here, and recently in 2021. And that is the end of this lecture.